Have you ever had a brilliant idea and thought, man, if I just had the cash, I can make this happen? Well, companies face that same problem all the time. Today, we're going to break down exactly how they go from a simple idea to raising the capital they need to build an empire, and how that whole process creates opportunities for you, the investor.
All right, so let's get right into it. Picture this. A company has a game-changing product. They've got the vision, they've got the team, but they need a ton of money to, build the factories or hire the software engineers. Where on earth does that money come from?
Here's how we're going to tackle this. First, we'll look at the huge choice every company has to make. Then, we'll dive into the two main options they have, the world of bonds and the world of stocks. After that, we'll see how investors actually get paid. And we'll finish up with some really interesting strategic moves the corporations make. Okay, when you strip everything else away, it all comes down to one massive question. Does the company borrow the money and promise to pay it back, or does it sell off little pieces of itself to new owners? It's a fundamental fork in the road. And that brings us to these two big concepts, debt versus equity. Taking on debt is essentially like the company taking out a giant formal loan, and they do that by issuing bonds. The other path, selling equity, means they're selling stock. They're literally bringing on new partners in exchange for their cash. So let's go down that first path, borrowing money. When a company decides to do this, they step into the world of bonds. So what exactly is a bond? Honestly, the easiest way to think about it is as a really official IOU. An investor gives the company money, and in return, the company promises two things. They'll pay back the original amount on a specific date in the future, that's called the maturity date, and along the way, they'll make regular interest payment. Now, this whole deal has three main players. You've got the issuer, that's the company that needs the cash. Then you have the holder, that's the investor lending the money. And the thing that ties them both together is called the indenture. This is not some simple handshake agreement. It's a super detailed legal contract that spells out every single rule of the game. So why would a company do this? Well, from their point of view, there are big pros and cons. The biggest pro? The interest they pay on these bonds is tax deductible, which can save them a ton of money. Plus, the bondholders don't get to vote or tell them how to run the business. The downside, though, is huge. Those payments are a legal requirement. Miss a payment and you could be forced into bankruptcy. It's a serious risk. And it's really important to remember that not all bonds are created equal. You have this whole hierarchy of risk. At the very top, you've got super safe stuff like U.S. Treasury bonds. As you go down the ladder, the risk gets higher, but so does the potential reward for the investor. All the way at the bottom, you find what are called junk bonds. They're high risk, but offer high yields to compensate for that risk. The price a bond sells for at the beginning is all about a tug of war between its interest rate and what the current market rates are. If the bond's rate is the same as the market's, it sells for its face value, or at par. But if its rate is better than the market's, well, everyone wants it. So it actually sells for more, at a premium. And if its rate is lower, they have to sell it for less, at a discount, just to get people interested. All right, so that's the whole story on borrowing money. But what about that other path? What if the company decides to sell off pieces of itself instead? Well, that brings us right into the world of stocks. And this right here is the absolute key difference. When you buy a share of common stock, you're not just a lender anymore. You are now officially a part owner of that company. You get to share in all the potential glory, but you also share in all the risk. Now, there are really two main flavors of stock, common and preferred. With common stock, you get voting rights. You actually get a say in who runs the company. Preferred stock usually doesn't come with a vote, but it has some nice perks. Think of it like a VIP ticket at a concert. Preferred stockholders get paid their dividends first, and if the company goes under, they're ahead in line to get their money back. Back in the boardroom, issuing stock looks pretty good because there's no legal requirement to pay out dividends, and there's no deadline to ever pay the money back. That's some amazing flexibility. But it comes at a steep price. Every share they sell waters down the ownership of the original founders, and unlike bond interest, any dividends they do pay are not tax deductible. So, you're an investor. You either lent the company money by buying a bond, or you bought a piece of the pie by purchasing stock. So, how do you get paid? For bondholders, it's those steady interest payments. But for stockholders, the big reward often comes through dividends.
So, what is a dividend? It's basically the company's board of directors saying, hey, we made some good profits this quarter, and we're going to share a piece of it directly with you, our owners. It's a cash reward for being a shareholder.
And paying out that dividend follows a very strict calendar. First, the board declares it. But the date you really need to care about as an investor is the ex-dividend date. You have to own the stock before that date to get the dividend. After that, the company checks its records to see who owns the stock on the date of record, and then finally, they send out the payments on the date of distribution. But it's not all just about dividends. Companies have some other tricks up their sleeve, some real power moves they can use to manage their stock and create value for shareholders. Okay, let's set the scene. Imagine a company has 1 million shares of stock out there, and they've been so successful that the price has climbed all the way up to $90 a share. That's awesome for the people who already own it, but a $90 entry fee might scare away smaller, new investors.
So, what can they do? The company might announce something called a stock split. In our example, they go for a 2-for-1 split. This is a really interesting move that doesn't change the company's value one bit, but it does change the stock itself.
And here's the result. Boom! After the split, there are now 2 million shares, and the price gets cut in half to about $45 a share. So if you owned one share worth $90, now you own 2 shares worth $45 each. Your total value is exactly the same, but that lower share price makes the stock feel much more affordable and can bring in a whole new wave of buyers.
Another one of these power moves is a share buyback. This is literally when a company uses its own cash to buy its own stock right off the open market. And why would they do that? Well, there are a bunch of reasons. They might need the shares for employee stock option plans, it can make their financial numbers look better, or it can even be a defensive move to stop another company from trying to take them over. And that brings us right back to where we started, to that fundamental choice. Do you take on debt, keeping full control but risking everything on making those fixed payments? Or do you take on partners, giving up some ownership in exchange for flexibility and shared risk? It's the decision that shapes a company's destiny. So, what would you do?